What the heck is going on with Affirm stock? In just the last few hours, it's down something like 40%. From a few months ago, it's down something like 70%. What is going on? This is some crazy volatility. Investors want to know, especially as you see their most recent quarterly results that continue to post hyper growth. So the question is, what does Affirm look like from here, especially as it's sold off so significantly? What's the current valuation framework? If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing, a no-hype mission-focused channel trying to find you exceptional companies and unrivaled investments. In full disclosure, this is not financial advice, and at the time of this video publication, I did not own stock in Affirm. So what is going on with Affirm stock? So Affirm stock went on this wild ride in just the last 24 hours as they accidentally tweeted out metrics for their most recent quarterly results, calling out 77% quarterly revenue growth and another great quarter in the books. Direct quote. This caused the stock to jump nearly 12%, only to later plunge as Wall Street realized their guidance and results weren't as hot as they expected. So management effectively put out a tweet saying, yeah, things are awesome. Then they deleted the tweet, actually posted the results later, and the results later included guidance where management's like, what? This isn't as good as we thought. So for a quick recap of what Affirm does, they enable merchants to offer buy now, pay later functionality. This is a triple win, I'd argue, for consumers, merchants, and Affirm, where consumers have no late fees, no compounding interest expense, and increased short-term buying power. It's very transparent in terms of what you're going to have to pay, and enables you to buy more in the short term. While merchants have more satisfied customers, more business, increased sales, all while avoiding discounting their branded goods. So this does create this sort of triple win, and that's what I like to see for a sustainable relationship. The reality is that their metrics are quite good from the top line perspective, significant and attractive top line metrics. You're looking at gross merchandise volumes, the amount of business that they're enabling, up over 115%. The number of active consumers using their products, up 150% to 11 million folks. Transactions per active consumer. So not only are there more active consumers, the consumers that are active are using it more often, and revenue growth of 77%, which is a nice acceleration from where they were previously. Management also estimates that Affirm processed around 1.6% of all U.S. online transaction volume for the Black Friday, Cyber Monday period, which represents a triple-digit increase from last year. This should make you think that while there are more than one buy now, pay later competition or competitors, so this is not truly unrivaled, Affirm is competing very effectively and taking share. So this doesn't meet the pure unrivaled test, but from a strong value proposition perspective and playing a strong game, I'd argue they're doing a good job here. While gross merchandise volume was up around 115% year over year, part of this growth was through their buy now, pay later rollout with Amazon. While the partnership with Amazon really got investors excited in the prior months, everyone's like, wow, Amazon's this behemoth and they're partnering with them. That's going to be great. It's going to drive a ton of business. The reality is it hasn't been as much as folks expected. Even excluding Amazon, they still grew about double year over year in terms of the amount of business going through their platform. What's really mind-blowing, though, is that their land grab with getting new active merchants, that's up 20x. Let me repeat that, 20x plus from last year, from around 8,000 merchants to nearly 170,000 merchants. Now, a lot of this has come from their very successful sort of integration with Shop Pay installments for merchants on the Shopify platform. This was another example of finding a win-win deal, as Shopify owns a little under 10% of Affirm stock. Okay, so despite what I'd argue are very strong top-line results, why is the stock melting down from here? So first, I'm actually not that surprised to see the stock down significantly. I previously called out at $123 a share versus the $46 a share now, how the valuation was not compelling at 30 times sales. The funny thing is, several trolls called me a dope as it rallied something like to $170 in the following weeks, and I'm just like, look, I'm making a shot. I'm making a guesstimate of where I think, the reasonable valuation framework pencils it out. And that's what I try to do in every video, saying, hey, fundamentals matter. In the short term, valuation matters more than fundamentals, because in the short term, Valuation can cause every sort of daily change. That's the change in valuation. People saying, oh, I'm going to pay a little more or pay a little bit less. Sometimes it's a lot less, this 40% drop in Affirm stock, but the long-term picture is driven by fundamentals. So that's what this channel continues to be focused on, even if in a short-term period I might look like a dope. And sometimes, look, I call the fundamentals wrong, and that's why I encourage folks to comment. I encourage folks to join this community where they say, hey, here's some helpful feedback, or here's some thoughts on where this business actually could be in the future. So why is the stock melting down? So while management raised their guidance for the year, Wall Street expected more. Why? So previously their guidance didn't include the benefit from their integration with Amazon, but now it does. And that's about a 5% lift, which is around, I think, a little under 100 million revenue impact. So that is a lot less than folks were excited about. People were really, oh yeah, Amazon, pumped this stock up. And now they're like, well, wait a second, this isn't really driving their outlook for this year. And so that does put a damper on things. They're also guiding to around 50% growth this year, which, keep in mind, they just grew 77%, which was an acceleration year over year. So folks are saying, wait a second, you're really having a strong deceleration in their business during the second half of their fiscal year. Year to date, they're up 67%. So folks are wondering, like, what's going on here? Why are they penciling out only, around 50% growth? Does that mean their business is either facing tougher, competition, or is it just, industry? What's going on that they're expecting such a deceleration? We're also at this point where Wall Street is starting to get more sensitive to higher interest rates and potentially economic cyclicality. So, look, as the economy, potentially gets tighter with higher interest rates, some companies will get hit more. And so Wall Street, I'd argue, is starting to think about this. Like, okay, which companies might get impacted? So far, Affirm's proprietary underwriting models have performed exceptionally well. Management calls this out themselves on the quarterly conference calls. But credit risk, I'd argue, is real. They do shoulder some of it on their balance sheet. And higher interest rates ultimately could partially hinder their results, could make it harder for them to grow. It is concerning that delinquencies are higher recently versus the prior year, and so that was sort of a wait a second, 2022 delinquency rate is higher than 21. Now it's still better than 2019. So folks are saying, what's going on, man? And so what's going on here is that you have, and here it is. Let's do the direct quote from the CEO, where he's talking about, look, so I'll never tired of repeating it, but we chose the delinquency number we post, i.e. they're effectively, based on their models, they choose whether or not to underwrite, and they say they are able to effectively control where delinquencies come out based on their models, saying, yes, this is likely what's going to happen. And we feel that we were probably retrospectively unnecessarily careful, or necessarily tight, for lack of a better term. So they previously tightened things up significantly, partly in response to the uncertainty of COVID, and now we've loosened quite deliberately, and we'll continue managing the number. So this is management's way of saying, look, we feel we control delinquency. Don't worry about it. If we wanted to bring it back down again significantly, we could. It's 2% versus 1%. Back in 2019, it was closer to 3%. Don't worry. This is still very much in range, and this is what we control. This is what we're guiding to, or this is what we internally are choosing. And so it is supposed to calm Wall Street to say, hey, we know what we're doing. We're controlling this. But it does, it's always a concern for Wall Street. Could this potentially, get in front of them? Is it possible you get your models wrong? That type of thing. And it also, I'd argue at this point in the economic cycle, it does make investors nervous to say, hey, you're deliberately loosening your credit standards. What inning are we in the economic cycle? It's certainly not the first inning. I'd argue it's closer to the seventh, eighth, maybe even the ninth inning in terms of where we are in terms of the U.S. economic cycle. So saying, hey, we're deliberately loosening does get folks to be a little bit more nervous. But that said, their delinquency metrics are still very fine. Okay, so now that Affirm is down something like 70% from its recent high, down about 40% from its high just in the last 24 hours, what about the valuation? What do I think about the risk reward? First, a quick plug where if you're interested in joining a community of fellow investors looking to learn and find exceptional companies, we have an exclusive community on Discord. You can sign up at unrivaledinvesting.com. Click Join the Journey. I also call out potential multi-baggers and share my own personal portfolio for those interested. Once again, that's unrivaledinvesting.com. Click join the journey. And if you enjoy videos like this, please make a point of hitting that thumbs up, hit that subscribe button. So first, it's important when you're thinking about the valuation of a firm to recognize that this is an immensely unprofitable business. They might talk about an adjusted operating loss that's way better, but really what you're doing is just adding back significant stock-based compensation, which means you're being diluted if you're not reporting those actual losses. So the market, I'd argue, is separating out, especially with the prospects of higher interest rates. The market's starting to separate out, okay, who's unprofitable, who's profitable. These unprofitable businesses that need to prove their margins, it should warrant a discount because you need to prove your profitability long term. And so that is a really important data point to consider whenever you're looking at a company. If you think, this type of company should trade at 30 times longer term, you're going to say, hey, it's unprofitable right now. Let's say 30 times earnings. It's unprofitable right now, so maybe you should underwrite it at 20 times. That's the sort of thought process, as you look at this market, because unprofitable things are getting haircutted with the prospects of higher interest rates. So looking at this is a deliberate move, for them to operate at these losses because they're looking to play the long game. They're looking to land grab, take market share, have really smart partnerships. So I'm not disagreeing with it, but you just need to recognize that's how they're operating right now. So even though a firm seems to be playing the game extremely well, once again, land grab, you see Amazon and Shopify partnerships, and they're taking share, not a question. I'm still arguably underwhelmed by the investment setup here, despite the 40% decline from the high just within the last 24 hours. So they still trade at something like 11 times forward sales and are extremely unprofitable, subject to economic cyclicality and interest rate pressures. So I'd argue this is like the inverse of a dream investment. A dream investment would trade at a lower valuation, would be extremely profitable, not subject to economic cyclicality, and could even benefit from interest rates, going up. So it's something to think about, and that's part of on my community. We're talking about trying to find those types of companies on a regular basis. Even assuming continued hyper growth of, let's say, 35 to 45% going forward, long-term profit margins of 15 to 25%, versus significant unprofitability now, and let's say an end earnings multiple 5 years out of, let's say, 25 to 35 times, that still pencils out upside of maybe 170% from here. And that just doesn't strike me as crazy compelling. So, of course, could the stock do really well from here? Yes. It could go up significantly from here if they continue to execute. And Wall Street gives it credit to, let's say, margins they haven't achieved and gives it a very, arguably reasonable multiple, 35 times earnings. Now, keep in mind, this is also a hypothetical framework. The stock price can go way higher or lower. A lot depends on management's execution and the underlying sentiment in the market. In this environment, once again, I'd rather focus on profitable companies growing at a reasonable clip or consider hypergrowth unprofitable companies after their valuations completely bomb out and trade at, let's say, 4 to 6 times sales. And look, if you look hard enough, turn over enough rocks, I strongly believe you can find those types of things, whether or not it's a profitable at a slower growth or unprofitable at, a much better valuation. So that's, that is the sort of dynamic to consider, is that you don't always have to swing just because you're like, I like the story, I like these figures, the stock's down significantly. It can still be like, I'd just rather wait for something easier. If you feel like I'm missing something, I'm definitely open to hearing it. I mean, it's possible maybe I'm being too conservative with their growth rate in the, the ensuing years. For I'm saying 35 to 45% compounded, especially given the most recent quarter, they grew at 77%. So, I'm definitely open to feedback there. I'd love to hear your thoughts. If you're a mega bull or mega bear on Affirm Stock, love to hear your thoughts in the comments below. And if you enjoyed this video, please make a point of hitting that thumbs up and hit that subscribe button. Thanks so much for tuning in.